Howdy y'all. It is me with my home whiteboard, and just in case I have to miss class tomorrow, I wanted to give you some exciting lecture to try to get everything caught up through Friday. I do not believe I'll be sitting here for 2.5 hours, which is the normal class time we have, but I will indeed try to do my best to give you the most important concepts. First thing, I want to review, let me look at my monitor here. Okay, first thing I want to review real quickly what we did today. Let's see here. Okay, can you see that? Yeah. Davidson's capital market graph. Quantity of physical capital, price, all right? Now, let's see here. First thing, the easiest thing to do first is to, maybe I shouldn't be doing it here where there's a crack in the screen. Sorry, there's that, yeah, that's okay. K1, S sub K, that's the current stock of capital. So like the current number of restaurants, the current number of factories or whatever. So it's a vertical line because that's just how many there are right now at this second. That's the current stock of capital. Then the demand curve, the demand for capital, let's see, I, whatever that Greek letter is, and E, minus, minus, plus, plus. Okay, those are the determinants of the demand for capital. I mean, the price of capital, or the price of getting a restaurant, for example. This is the rate of discount of future income, so the higher that is, the more you're like, I'm not going to wait around, I'm going to spend the money today. Oh, I better not say J.G. Wentworth, that's like a, well, they'd have to pay me, actually, now that I think about it. Just like on J.G. Wentworth, I want my money now. So when you feel like that, I is very high, if you will, and so the demand for capital is lower, because you're not willing to sit there and wait as you wait for the years of income coming from your restaurant. This is the profit you expect to receive from whatever the capital is going to build. So for example, if it's a restaurant, from the foods you're going to sell in the future. And this is the ease with which entrepreneurs can get access to finance. All right, so now the demand curve. Well, this one's the only one that's going to be reflected in terms of the slope, because we have that on the vertical axis. All the others would represent shifts. If we change one of these, we'd have to shift the whole demand curve. But let's put the demand curve on there. So now what we have is sort of entrepreneurs' valuation of how worthwhile it is to get a unit of capital right now. It's their demand for capital. Here's the current supply. If I could buy an existing restaurant, I'd pay that for it, all right? So that is the demand price of capital, all right? That's what the demanders would be willing to pay for a unit of capital. Well, turns out, however, let me change colors here. Turns out, however, you are not limited to just purchasing the restaurants that are already in existence. Turns out you can build some new ones. So now we need a supply curve for representation of the construction of new restaurants or new physical capital. First of all, P sub M, that's a minimum price. No one's going to build you a restaurant for less than this, all right? So it's not going to come out of the bottom down here, because there is no physical capital. The assumption here is that you can buy for, $1 or whatever. So this is the easiest way to think of it. It's the minimum price at which you could get a contractor to agree to build a restaurant for you. Then we pull the demand curve, the supply curve off of right here, because we're already starting here, all right? We're already starting this far out. So we already have this many. So this is the question here is of adding to that current stock of capital. So this is S sub K, which we already had, because it is that. It's that far to the right. It's this far to the right, plus lowercase s sub k. Can you see that? I don't have my glasses on anyway. In the book, in Davidson's book, this is simply a lowercase s, but it's kind of hard to see lowercase or uppercase on here, so I like to use a little script s. But the lowercase is just this blue part, just this blue curve here. That's new construction, all right? And then the uppercase, of course, is why it's that far out to the right in the first place. Okay, so it looks like we've got a good idea of what the supply of restaurants looks like, or supply of capital. There's one important thing missing, and it's going to be really important to understand that there's a difference between building a new restaurant and upgrading or repairing the old one, of just fixing up depreciation, all right? So we have to include the demand for capital just arising from depreciation, just arising from, oh, the easiest way to think about it, but it doesn't just mean this, but the easiest way to think about it is, oh, our fry cooker is really, broken down. We need to buy a new one and put it in there. So have you expanded your ability to fry stuff? No, it's exactly the same as it always was. But so but you did contact a company and buy investment goods, or capital goods rather. So this is nevertheless demand for capital, but it's demand for capital just replacing old stuff that's worn out. And actually that's something that Keynes makes a big deal out of it. It's not just worn out, because we don't really care about the actual productivity. I'm not going to go into it, but it has more to do with, is this capital worthwhile? Is it useful more than has it worn out? But maybe I'll talk about that in class, maybe I won't. It turns out not to be entirely necessary to understand the graph. All right, let's say that the total demand for capital is the original demand curve, so we're that far out to start with, plus this lowercase d sub k. That's demand for capital just to replace stuff that you already had built. You're replacing what you already had built. It's wearing out, it's not up to code or whatever. It's not making enough money for you. You're not putting in, you're not expanding your ability, you're just trying to stay in the same place, all right? Now we have, finally, the total demand for and the total supply of physical capital. Perhaps I shall use a green marker. No, purple. The total supply of, which is here, and the total demand for capital, right in here. So, this must be the equilibrium price. Davidson labels that P sub F for the flow price. But the way to think of it is the supply price of capital. This is the price that you would have to pay to get somebody to supply it. This was the demand price of capital. This is the price that demanders were willing to pay. The price that people are willing to pay is above the price that they have to pay. Therefore, they're going to buy capital. All right, and they're not just going to buy capital. They're going to add to their total productive capacity. Let's see what color. I wish I had a red one. All right, first thing, I'm going to drop down from here and call that K sub 3. That is total investment. All right, gross investment, total investment. That is the number. Move my shoulder out of the way. If we were using the ZD diagram, ZD, that's that number. All right, that's the vertical intercept. So whatever number is there, that's the equivalent of that vertical intercept right there. It's total investment. But not all of that investment was for building brand new restaurants. Some of it was for upkeep on old restaurants, all right? So we need to differentiate that now. Well, remember, the gap between the black and blue demand curves is the lowercase d. It's the demand for capital because we're just doing upkeep. So we know that this gap right here is just, and I'll put REPL for replacement. That's just replacement capital. And this is net capital formation. This is the net addition to the total number of restaurants or whatever we're talking about, all right? So here's the total investment, but of that total investment, this much was just for entrepreneurs to try to stay in the same place in terms of what they thought was a profitable amount of capital to have. And this was, oh no, we're going to add a new franchise, we're going to add a new restaurant, we're going to add a dance floor to our restaurant, whatever, right? That's it. Now, here's the important thing about Davidson's graph. On the surface of it, it's just a general equilibrium thing where everything comes to rest and stops. But of course, from the post-Keynesian perspective, that's not the way the macroeconomy works. The macroeconomy is dynamic. And indeed, there's a dynamic element here. Because in glancing at this, let me give you a comparison. I don't know how well you can see it, but it's just a supply and demand diagram, all right? So I just got P sub 0, Q sub 0, yeah, you can see it. P sub 0, Q sub 0 at the intersection of supply and demand. And now, so where's the price right now? Well, it's at P sub 0. Where's it going to be tomorrow? I don't know. I mean, unless something happens, it's still going to be at P sub 0. What's the quantity right now? It's Q sub 0. What will it be tomorrow? I mean, Q sub 0, I guess. Aha, not the case here. What is the Demand price for capital today, P sub S. But it's not going to be there tomorrow, and I can already show you where it's going to be tomorrow. What is the supply price? P sub F. What is investment? This gap down here. We already know, okay, everything else being equal, we already know that tomorrow, or next month, or whatever the time period is here, this whole supply curve apparatus, the black and the blue line, everything that has an S on it, is going to move to the right, okay? It's going to move to the right, and why do we know this? Because there's net investment. We know that this is going to be the net addition to the stock of capital. That whole apparatus. It's really hard to do this next part. Let's see, make it exactly the same. Let's see here. Yeah, it comes across right there. Hey, I don't know if that's parallel or not. That's why I like to do this. One time when PowerPoint's really handy, because I can block copy and just shift it in I don't know, I usually use MS Paint, and then show it on the PowerPoint. Here you're going to kind of have to guess. But I don't know if you're going to be able to see this or not. Let's see. The new P sub S is right here. There's the new P sub S, the intersection of DK and SK. And here is the new P sub F, the intersection of the total supply of capital and the total demand for capital. Look how close together they are, all right? They're getting closer and closer together, which means that the incentive to undertake investment other than just for replacement is going down, down, down. Well, that really sucks, because we need the demand curve as high as possible in order to generate more employment over here. So that's kind of what we talked about today, all right? I showed you this situation, and then I showed you the situation where P sub F was higher than P sub S, and in that case, you don't even bother to replace all the existing restaurants. You let some of them sit empty because you think that the value of these restaurants is below even what it would cost to build a new one. You just let the old ones wear out, all right? And I also mentioned that the way this graph is set up in the Davidson book, he says, well, and what's going to happen now is, and why he says this I don't know, because I know he doesn't believe it, that eventually, and notice how close together P sub S and P sub F are here, eventually they end up P sub S equals P sub F, all right? Net investment dropped to zero, and all investment is just replacement, which means that entrepreneurs have reached the number of restaurants that they believe will be profitable, and all they're doing now is just replacing the stuff that wears out, all right? So we come to this steady state. The economy reaches a point, like let's say we had an economic expansion. Where am I going to draw my economic expansion? All right, economic expansion, and it just levels off, all right? It just levels off after that. Guess what? We all know that's not what really happens. We all know that this is what happens, all right? So that's the next thing that we need to add, all right? So very next thing, I said a little bit about it today, but not much. All right, so check this out. Now, in order to introduce this next concept, I have to tell you a little bit something about Keynes, John Maynard. And do I have a copy of the general theory here? I do not. I do have a copy of Paul Davidson's Money in the Real World, from which his textbook was drawn. And you can see John Harvey has underlined many, many things in here. No. General Theory of Employment, Interest, and Money. Okay. Now, Keynes was, and there's Captain Jean-Luc Picard from the Starship Enterprise. Keynes did not have a degree in economics. He had a degree in mathematics and statistics, and he was a great mathematician. He won awards all the way through primary school, through high school, and through some university called Cambridge. So anyway, apparently he's a pretty good mathematician. But one area that he thought did not, sort of standard mathematics didn't apply to very well was investment, all right? And this is my most recent iteration of my example of trying to explain what he's talking about here. And as background, he's going to say that in the real world, decisions are not risky. Risky is like when you go to Las Vegas and you put money down on the roulette table. You know the odds. You know all the possible outcomes. You know the odds of each outcome. So really, in a probabilistic sense, you know the future. All right. He said that's not the way the real world works. Not in important decisions like this. That instead, in the real world, it's uncertain. You don't know all the possible outcomes. You don't know the odds of each outcome. And so what you end up with is much more volatile behavior. And remember from the earlier reading that there is no more volatile component of GDP than investment, all right? So he's saying that the investment decision, actually many decisions in life, are made in an environment of uncertainty. All right, so what does that mean? Okay, here's my latest example. Let's say at the end of the semester and you're failing your class. And it's going to cost whatever it is at TCU right now, $4,000 to take it again. It's going to be another 15 weeks to take the course. You're going to have to study this time. And you also face the prospect of telling your parents that you've failed a class. But TCU has come up with a new idea. You can go to the registrar's office, all right? Anytime from, I don't know, week 12 on through week 15, you can go to the registrar's office. And by the way, if Chancellor Bashini is watching right now, this is a great idea. You go to the registrar's office, you plop down $1,000, all right? Or just do it on a send home on your ID. And this gives you a chance. They then usher you into a room at the registrar's office where they have a tray with dice on it, all right? And they say, you may roll one of these dice, and if you roll a 1, you get an A in the course. If you roll a 2, you get a B. I think you see where this is going. You roll a 3, you get a C. You roll a 4, you get a D, and anything above a 4 is going to be an F. All right? So you walk into the room, but they offer you 4 different dice. All right? They offer you a 6-sided die, an 8-sided, a 10-sided, and a 12-sided die, all right? So they're all on this little tray that they come in, this gold-plated, because we're making lots and lots of money off this whole thing. They offer you these dice, right? So which one do you select? Which one do you choose? After you plop down your $1,000, which one do you choose? Obviously the 6-sided die, right? So you roll the 6-sided die, dang if you didn't get a 5, so you've still got an F. But you can play this game as often as you want. So you plop down another $1,000, and this time you select which die? Well, the exact same one. But you roll a 6. Well, hey, the course is $4,000, right? You're only in for $2,000 right now. Plus, as I mentioned earlier, you got to study for 15 weeks, and you have to tell your parents, hell, I'll pay another $3,000. And now which die do you select? The exact same one, all right? In a world where you know all the possible outcomes, you know the odds of every outcome, it's a very calm world, actually. Obviously, you're getting a little bit upset as you roll the dice here, but in terms of your choices, in terms of the choices of which action you want to take, it's actually pretty straightforward, all right? We don't get the sort of volatility that you see in the real world when we have what Keynes called risk, all right? Okay, now let's set up a Keynes world, which sounds like some sort of horrible amusement park. In Keynes' world, when the registrar's assistant comes out and offers you the tray of dice, this time, that's box A, that's box B, all right? You don't know what kind of dice are in there. And by the way, I looked it up one day. You can theoretically purchase dice with up to 100 sides, all right? And you can also have a 2-sided die. That's called a coin, right? So of the 2-sided die, wow, you're just going to get an A or a B. What a wonderful situation. You don't know what dice they've got in there. There could be a repeat of the 12 and 8-sided dice, right? But, you know, it's still worth $1,000 to you, all right? You're like, well, crap. I mean, I don't want to go home and have my parents find out. So you go in and you put down your $1,000. And notice here, Keynes says it's not like you're totally ignorant of all the possibilities. You use rationality where you can. You use it where you can. So what's the first thing you do? I'm never selecting the 12-sided die. That makes no sense. I already know the 8-sided die is better than the 12-sided die, all right? But now I've got 3 choices. I don't know, I'm just guessing here, but I would suspect that most people would tend to go with the 8-sided because they know what it is. People, and psychologically, it is true, people like certainty, all right? They will overpay for certainty. So let's say you choose the 8-sided die, all right, and you roll and you get a 7, all right, so you still got an F. And so you put down another $1,000. Maybe you do the 8-sided die again. You put down another $1,000, and now you're getting a little desperate, all right? And now you're thinking, what the hell am I going to do? I don't know, let's give A a shot, all right? Now the point here is not that you will choose A, but that you will actually consider it, all right? In the other scenario, six-sided die, and that was it. There was no other possible choice. You were always going to choose the six-sided die, period. Here you're considering other options. Here you're thinking, geez, especially when things aren't going the way you wanted them to, especially when they're going against you, when you're disappointed, and that's the real problem in the business cycle. When you're disappointed, now you're thinking, I don't know, let's try B and see what happens. Let's make this even a little more interesting. Let's say that there's a line of students waiting to come up to this big craps table that they have to roll for your grade, and the person in front of you used die B and got a B, all right? Now, is that going to influence your decision? Even though you have no idea what that is, all right? And the registrar never tells you. All they tell you is the outcome of the roll. The person in front of you, though, used die B, and they got a B in the class. Is that going to influence you? Well, of course it is under these circumstances. You're scared. This is a very important decision to you. You want to make sure it works out right. You might choose B. Especially if the first two people, and for all we know, it's a 20-sided die, all right? And that person got lucky. And it's mathematically possible for the two people in front of you to have selected what is actually a 20-sided die, and both of them get a 1, 2, or a 3. Certainly possible, all right? Not going to be common, but it's absolutely within the realm of possibility. All of a sudden, you're sitting there stuck on B. And by the way, the registrar doesn't tell you, oh, you rolled a 20. They're just going to say you got an F, right? So you don't really know. The real world is much more complicated. You don't really know other than you failed, all right? So now you're bouncing back and forth between these things. And this is where Keynes, and I got to tell you, for years I never understood the significance of this part of the theory, of how important uncertainty was, of how important it is to the fact that people become euphoric and people become, panic. Now, one thing you might think is, well, in a perfectly rational world, no one would ever go do this at all right? Because if I don't know all the possible outcomes, why would I do this? Well, that's where Keynes says, aha, we aren't dependent entirely just on rationality. Remember, you did use some rationality to cross this one off and use this one instead. We're not just rational. We're also emotional, all right? And we rely on animal spirits, which sounds like some sort of horrible drink from West Virginia that you make from possum innards, but as my dad is from West Virginia, I can guarantee you that such a thing does not exist. So, animal spirits, it's a spontaneous urge to action rather than inaction. It is you saying about building this new restaurant, oh, what the hell, I think I can make it work. I believe in myself. I believe as an entrepreneur that I can come up with new ideas. It's going to work for me, even though 3/4 of all small businesses fail within the first 4 years. Mine won't. All right, so I have this spontaneous optimism, this confidence, without which this guy right here says that investment will grind to a halt if we did not have this sort of urge, this spur to activity. All right, so we've got this world of uncertainty, and while things are going well, you're like, I'm a genius. I'm a business god, and so you become overconfident. And this is not quite the same thing as the stock market, but in the stock market during the 90s, when it was going up by 20% in real terms for 5 consecutive years, which is impossible to sustain, people were thinking, I'm a genius. I've worked out a system in the stock market, when in fact a monkey could do well in the stock market in the 90s because it was doing that, all right? So pretty much any portfolio you put together was going to win. So people were convincing themselves, in a world like this, I know what I'm doing. I'm going to cash in my retirement at work, and I'm going to play the market myself. And they got destroyed, those that were playing this game at the end. And when things start to turn, all right, and this is where this kicks back in again. When things start to turn, P-A-N-I-C. It is always safer not to spend than to spend. So if you're not sure what's going on, you're uncertain about this turn right here, get the hell out as soon as you can, all right? So as Keynes says, somewhere in here, the error of optimism changes to an error of pessimism, and that's where we get the volatility, all right? We get the bouncing back and forth. Okay, let's go back to the graph. And let's see here. Let's go back to the graph. This is what's going to happen. What we never did, let me jot down one of those graphs. What we never did in my previous example there, let's see, that's quantity, price, vertical SK curve, case of 1, SK plus SK. Let's see, I'm going to go ahead and set this up where I already know what the, yeah, that'll work. No, I'm not going to do it that way. All right. DK plus DK. Let's see, that's PS. No, it's not, it's PF. That's PF, that's PS. Okay. So there's the price you're willing to pay. There's the price you have to pay. It's going to cause a lot of investment, right? K3. Well, where are those animal spirits going to come in? They're going to come in on the demand curves, all right? These are forecasts. These are made in an environment of uncertainty. These entrepreneurs don't know all the possible futures. They don't know all the potential or all the odds of each possible future. And they're being driven in no small part by their sense that they know what the hell they're doing. But the level of confidence changes a lot over the course of the business cycle. Sorry, I was disappointed with my DK there. So that didn't really help. Check this out. As I've mentioned to you numerous times, it's very handy to split the business cycle or the expansion into an early part, a mid part, and a late part, all right? And then, of course, this is the recession, and this is the recession here. In the early part of the expansion, as I was saying today, let's see, firms have not been investing much during the recession for obvious reasons. But eventually, you know, at first you put off any new investment during the recession because you think you're not going to recoup your costs, but eventually you got to replace stuff. I mean, if you've got 4 registers at your grocery store and 2 go down, maybe you can make do with 2 of them. A third one goes down, you probably got to, you need to replace a register. So what's going to start happening is investments going to start to go up down here, and it's going to be a surprise. All right, investment is going to start rising. Plus, the bad memories of the recession are starting to fade as well. I don't know if you can see that, but it's a smiley face, all right? In the early part of the expansion, when investment goes up, it is unexpected, and it causes a rightward shift in the demand curves. Now, why that's important is, see this increase in investment? That's still going to cause a rightward shift in the supply curves, all right? But the demand curves are going to shift even further. How do we know? We don't. It just seems to make sense based on the fact that it matches what happens here in the business cycle. If the supply curves are shifting right, why does investment continue to rise? It must be because the demand curves are shifting even further to the right, and that makes perfect sense in the context of decision makers in an environment of uncertainty. They're like, oh my God, things are working out great. Let's go. So I was using green. In the mid part of the expansion, investment accelerates, all right? But this doesn't surprise anybody. That's kind of what they expected. Okay, so the supply curves move to the right. The demand curves don't really move. So we have a reduction in investment, but the investment is still, of a high magnitude. There's still a lot of investment going on. But as the supply curve continues to shift to the right, and the demand curves don't move, because the assumption here in the model is that the demand curves only move when there's a surprise. A positive surprise, they shift right. A negative surprise, they shift left. So during this period right here, the demand curves are sitting still, but the supply curves are slowly moving to the right. So what's happening to investment? Eventually, investment starts to fall, as it has done in every recession, or I should say at the end of every expansion since World War II except one. All right, and then that was either the Vietnam War or the '73 oil crisis. I can't remember which one it is. So, but this happens, right? You didn't expect it. When investment goes down, if we want to go to Koleski, which we'll do later in the semester, investment and profits are highly correlated. But let's just do the general multiplier idea right now. When investment goes down, it lowers GDP because you have Y equals the multiplier times A plus I plus G plus X minus M. I is going down, so incomes are going down, so sales are going down, and you didn't expect it. At first, you may write it off. Thinking that, well, it's just a temporary thing. Kind of like if there's a football team that you expect to do really well and they lose a game to an easy team. It's like, well, okay, but then they lose another game, and then they lose another game. You know what? This team actually sucks, all right? So that's what's going to happen up here. That as the investment numbers are shrinking, then at first you may say, well, you know, this happens. It's volatile. People know this, it's volatile. But eventually you realize, no, it's going down. And sales are going, actually they're not watching the investment, they're watching their sales. As these people have opened their restaurants, they're watching their sales, and their sales are of course going down. Their profits are going down because y equals c plus I plus g plus x minus m. All right? Again, later there'll be an even more direct link between investment and profits. So now we have not only did we have the supply curves shifting left up to here, but now we've also got the demand curve shifting right. I'm sorry, I just said that entirely backwards. Not only did we have the supply curve shifting right as we moved up here, as investment continued, even if it was shrinking, it's still continuing to move right. We also have the demand curve suddenly jumping to the left because there's this negative surprise up here. It's like, oh my God, let's just stop. All right, it'd be much safer if we just stopped. So that's what's going to happen on this graph. That in the early expansion, when people have this positive surprise, the demand curves jump out to the right. In late expansion, when we have investment shrinking, all right, because we're reaching the stock of capital that entrepreneurs believe will be profitable, the demand curves shift left, all right? So what does that give you? It gives you that. Now, returning to the notes and telling you where this is, let's see, study question Nummer, that's German, Nummer 36, all right, 36. This is the one talking about the stages of the business cycle. I wonder if I can make this legible if I walk up here rather than have to write the whole thing on the board. I'm not wearing my contacts right now, so I can't actually see the monitor very clearly. Hey, that could be worse. Okay, so what we've got here then is in the chart on 36, in early expansion, investment spending is kind of moderate. Expectations are like, you know, well, it's not as bad as it used to be. But hey, profits aren't half bad. And the reason is because investment's jumping up, all right? Mid-expansion, everything's booming. But we kind of expected that. So, and I'm sorry, I should stop and, oh, that's this hand. That means that better than expected over there is going to mean a rightward shift in the demand curves, all right? Then on this one right here, we've got no shift at all because it's what everybody expected. But then late expansion, investment's still positive, but it's slowing down, net investment I should say, because investment always has to be positive or zero. But net investment is slowing, and therefore overall investment is slowing, and it's disappointing. All right, as Keynes says here in the good book. What is it that Keynes says here in chapter 22? I love that part. Well, I don't know. I'm not going to make you sit here and wait for me to find it. Ooh, that's where Jean-Luc Picard is right here. But chapter 22 is his notes on the trade cycle, where he goes over the business cycle. And he talks about in here somewhere that, you know, hey, the profits you're making up here, under other circumstances, you would have been, oh, that's not bad. But you weren't expecting that. You were expecting better. And when you built this restaurant, you were expecting a certain rate of profit and you didn't get it, all right? And now the other restaurants that you started building, you may stop building them and other people decide not to jump in and so forth, and that's that. Now, I emailed today the PowerPoint that goes through this as well.